the two sessions. Thank you for sticking it with us. I was thinking about it as I turned on my microphone here that this may not be as entertaining as binge watching your favorite show on Netflix, but for those of us who are transportation nerds, hopefully it is somewhat entertaining and at least informative and maybe more professionally relevant. So thanks for sticking it out. This session is, let me pull out the official title here. This session is called Current Global Events and Their Impact on Transportation Energy. Debnil Chowdhurty with IHS Markit is joining us. And let me give you a little context on the session and then go through a couple of housekeeping things. Earlier today, we started talking about consumer perceptions, and then we went into the last session where we talked about policies and initiatives that could affect transportation market for their impact on emissions and economic conditions. This time, though, we're getting a little bit more tangible and real. Last year, 98% of all vehicles sold in the United States were powered by liquid fuel. And the primary liquid fuel is refined petroleum product. And if, we know that the pandemic has been an interesting time in everybody's lives, but if you've been watching the oil markets at all this year, you know they have just been dumb crazy. It has been an unbelievable year, from the complete drop and destruction of demand for global travel, stay-at-home orders, to the oil price war between Saudi Arabia and Russia, culminating in negative priced futures, gasoline selling for low dollars. Everything's just been kind of all over the place. And now we're entering the hurricane season with the first named storm approaching the East Coast this week. I started thinking about this. The pandemic is one major situation that's affecting global transportation energy markets, but there's so many others, whether they be natural disasters, they be trade wars, they can be military conflict in energy sensitive regions of the world. All these things have a trickle effect that affect the markets across the globe, the United States being no exception. This latest one was pretty dramatic, and it's something we need to be paying attention to. So that's what we're going to be talking about in this session. Real quick, if you have not been on yet, if you have any technical difficulties, use the chat function to reach out to the Fuels Institute host, and Donovan Woods will do whatever he can to resolve your technical issues. If you have questions, use the Q&A feature at the bottom. At the end of Debnil's presentation, I will go through those and present them to Debnil for his ability to respond to them. On Friday, we're going to be sending out a link to everybody with the on-demand recordings of all these sessions, and you'll have access to those until June 5th. The speakers that have authorized us to distribute their slides, will make those available to everybody on June 5th. I do not believe IHS is going to be making their slides available because they're using a lot of the proprietary data, but if that changes, we'll definitely include it. If you're looking for speaker slides that are not in that package on June 5th, because we did not get authorization to share them. But we are very fortunate to have them on board. I think IHS Markit and my close familiarity with Opus have been great friends of the Fuels Institute, and they do a great job of analyzing the market. So with no further ado, I'm going to recognize Debnil. If you can go ahead and unmute yourself and show yourself. There you are. Welcome, Debnil. Thanks for joining us today.
All right. Thanks for having me. Okay, so today we're going to talk a little bit about really what's happened here in the global energy market, specifically really gasoline and diesel due to the virus, and also how we can prepare over the next several years for some of the big changes that are going to be happening here. So just a disclaimer slide, this slide's, we have to show this legally, but we do show a lot of forecasts. So we will share some of these slides redacted a bit later on, but if you want to distribute it publicly, please write to us first before you do that. And also, this is not legal or financial advice. Things like the virus could happen, it completely throws off our forecasts, so kind of use it at your own risk. Just real quick, how we fit in with Opus. I think a lot of the people here are familiar with Opus. We're really the forecasting arm of IHS Markit. So what you'll be seeing here, it's a subscription product. We have products that cover crude, refining, lubricants, and many other services. Most of our forecasts go all the way out to 2050. And they're heavily dependent on auto forecasts and economy forecasts that also come from IHS Markit. Those are the two things that you really need to pay attention to, and I'll give a little primer on what our views are in the economy and crude as well before we get into the products. But if you're interested in some of our services, just email us at omdcsales@ihsmarket.com. We have some specials going on now. Due to the virus, we typically don't offer 3-month subscription terms, but we're doing that to help the industry kind of get through the virus time. So what I'll be discussing today, we'll first talk a little bit about the economy and crude, then we'll move on to the US specifically, our gasoline and diesel outlook, and then I'm going to talk a little bit about our regional gasoline and diesel outlooks. And the reason we need to pay attention to what's happening outside of the US specifically is that as demand here falls, we will be dependent on exports to a greater percentage than we are today for our production here. So that's going to be a common theme, and it's important to know who you're competing against for gasoline and diesel that's produced here in the United States. And then I'll close it out with some risks to our forecast. So there's quite a few current events right now that's impacting gasoline and diesel. And obviously, the biggest one is the virus. We had 2 really good presentations before mine from Deloitte and Ricardo specifically on the auto fleet and also the standards themselves. So I'm not going to talk too much about the fleet itself and regulations. Really, this is our output on the impact on actual demand that those 2 major changes have to our forecast. One thing I will call out is that's very important just for the world gasoline market is the slowdown of growth in China. I think the whole world, since my career started at least, we've been really dependent on China seeing very significant growth in VMTs and gasoline demand. And I think one of our key messages is that growth is expected to start to slow, and that's going to have impacts on the entire global market when it comes to fuel demand. And then finally, this is something that's starting to happen now, but is really going to become prevalent over the next several decades, is the thought of what refiners are actually producing. Are they producing transportation fuels, or are they producing feedstocks for the chemical market? And one thing that you'll see in a lot of our forecasts that we put out when you go all the way up to 2050 is as gasoline demand declines in the US, we need to yield shift away from gasoline to naphtha. And why is that? That's because naphtha as a petchem feedstock continues to grow. So it's going to be important in the future if you're in the gasoline market to really know what's happening in the chemicals market, because you're going to be increasingly fighting with them for that light ends barrel that can go to either gasoline or naphtha in the future. So a little bit of just primer and background on what's happened thus far. Now, obviously, this looks pretty bad, and we are at the bottom of this crisis, probably the apex of what's going to happen as far as peak decline in the U.S. and globally. And I think I would like to try to change the mood of the entire industry now to think of this as a positive in a way, because now we've seen the biggest annual decline in history for both gasoline and diesel demand this year. And we've never seen something this great before, either on a quarterly basis, monthly basis, or an annual basis. But the good news is moving forward, if our forecasts are accurate and we don't have a massive return of the disease or some other crisis happen here, we do expect this to be one of the largest increases annually in history of demand once we go from 2020 to 2021 and 2022. So you have to look at the bright side that there is quite a bit of growth here coming over the next several months. The one big issue, though, is that we do believe that this will have some structural changes to gasoline demand. I'll get into this a little bit further once we get further into the presentation, but the big picture here is that we don't believe that gasoline demand will reach the previous levels in Canada and the US combined that we were seeing back in 2019 prior to the virus. And a lot of that has to do with fuel efficiency standards and many of the topics that we've already discussed here today. Gasoline or gas oil and diesel demand, not as negative a picture. It's tied more to the economy, but longer term, you will see that there's efficiency gains in diesel as well. But we do believe that demand will fully recover by 2022 to the pre-virus peak in the US and Canada. We've got a lot of questions recently on the safe vehicle standards and how that changes our views of gasoline demand. And really, it's a very minor impact, which is why I wanted to show this slide here. You see that we're talking about a 10 to 40,000 barrel a day impact for such a large light vehicle transportation market, right? So not a giant impact on gasoline demand. Really, I think the reason this is that the auto manufacturers, they're just already have their plans, their supply chains kind of decided for the next 3 to 4 years, and it would be very difficult for them to pull back on that at this point. So kind of moving on to the economy, and these are some of the key forecasts that really drive what we are forecasting here. And what you see is that, again, this was a very significant impact on global GDP. This was worse than the 2008 and 9 recession. That is one thing to note. When we were first seeing this crisis play out, before it was evident that it was going to spread to the US to the extent that it did, into Europe, I think everybody was kind of using 2008 and 9 as a floor to where gasoline and diesel demand could go. And we quickly realized in early March that that was not a good metric to follow, right? So we pulled out all of our models and really got to work in February and March to really figure out what would happen in April. And I'll share some of that work with you here in a bit. But long story short, North America had probably the greatest impact on its GDP. But because of that, we're going to come back pretty strong as well. So 2021 should be a very good year for GDP growth in the United States and Canada specifically. It's still to be seen how some of the other regions will play out. Latin America specifically is somewhat difficult to forecast because of the differences in winter. Brazil, for example, has a completely opposite seasonal schedule than the US, so there's a chance that the virus could take off right now because they're entering their flu season, right? The bottom left chart is very important, mainly for its history and how consistent product intensity has been. So product intensity is basically a measure of efficiency, and you see that that per GDP growth, how it's been a consistent decline. So the world has become more and more energy efficient as time has passed. And we believe that that's going to continue out over the next 10 years. And moving on to the next slide here, I think we'll talk a little bit about crude. And the reason I'll talk about crude is that you really need to understand the crude market to understand where gasoline and diesel pricing is going. And I think one of the things that really pops out here again, and this is the total liquids year-on-year demand growth versus world GDP growth. This was a terrible year when you're looking at the green bar. This is historically bad. But again, once we get into 2021, we will see quite a bit of strength, both in GDP and in world oil liquids demand. So this next slide here is very important as far as determining what's really driving crude oil prices. And this is our latest view as of yesterday. And this is something that honestly has changed quite often. This is why we do our monthly outlook every month. Actually, during the crisis, we were updating our crude price forecast probably about every week or so because there's so much volatility. But this general shape and what we have here, the red line did partially come true, especially if you go back to some of our March forecasts that there would be a huge crash as we were going from the April to June contracts for crude. And why was this? We were seeing that if you kind of go back to right before the crisis, the Vienna alliance was collapsing. The Saudis, they set their OSP prices to where it would incentivize exports to the US, really trying to drive down shale production. in the United States. And you actually see that global supply took off from Q3 all the way to Q1, the blue line on the left, whereas demand really fell off a cliff once we started getting the impacts of the disease in China and then in the US and Europe as well, right? And so what ended up happening is because supply was much, much higher than global oil demand, we had this massive historical increase in inventory, which caused crude prices to collapse like they did. And I think one of the key messages is that it's going to take some time here to pull down this inventory on a days of supply basis, which is why, you know, there is a good chance that in actuality, if we see that it's taking longer to actually take some production off the market in the United States, in the Middle East, and we see inventory continuing to grow and not pull like we're showing in our forecast, we'll follow a trajectory more similar to the red line on the chart on the right. But right now, our base case is that we are starting to see signs of improvement on demand for refined products. That works its way to the refineries. They're going to be running at higher rates, and that helps pull down inventory. And then at the same time, we're seeing US and Middle Eastern crude production fall as well, which helps balance the market, right? So hopefully we continue on this trajectory and see some increases here in prices to really help retailers from a revenue standpoint. I do know, though, that retailers are having a great year so far, just on a margin perspective. When you look at global gasoline demand year on year, kind of at the bottom of this in the second quarter, we were down 3.5 million barrels, which is 25 million barrel a day market for the world. So we're down almost about 15% for the world. It's much, much worse, though, for the US and some other regions here. And when you look at stocks, as of right now, it's not going to show up in this global data, but once I show you the US data, you'll really see it because it's more updated. But really, I think the net impact of this is that we've seen gasoline cracks globally crash significantly, right? So we've seen a crash in crude price, we've seen a crash in gasoline cracks, and now finally the past few weeks here, we're starting to see some hope and glimmers of recovery, and gasoline cracks are now starting to really come back up here quickly. Diesel globally, again, a very big impact as well. You know, it was delayed compared to gasoline in North America, for example, because we're a gasoline transportation market. But in transportation markets that are heavily focused on diesel, like Europe, the impacts were very similar on the time scale to what was happening with gasoline, right? So it's kind of different for different markets. But overall, the idea is that we've seen a significant decline in diesel demand as well. And because of that, you know, prior to the virus, this was supposed to be a great year for diesel. We had the IMO regulation changes coming into effect, which would have mandated higher diesel demand at the expense of heavier and fuel oils, higher sulfur fuel oils. And instead, we started the year with a really, really warm winter. That didn't help diesel inventory because we had heating oil demand kind of weaker. And now this crisis really has put pressure on diesel. But the interesting thing is that because of the timeline difference between gasoline and diesel, we actually had refiners shift initially from gasoline and jet yield to diesel, and now it's been a little overdone, and we're seeing inventory really grow here in the US. So our Opus colleagues, they have a great survey that's very extensive that actually covers actual sales of retail gasoline, and it matches the EIA data pretty closely most of the weeks, but sometimes it doesn't because of how the EIA classifies exports versus actual products supplied, right? So for example, for this week, it was showing a decline of 37% for retail demand, gasoline demand in the US, whereas the EIA was a little bit more optimistic. But there might be some differences in methodology and also how the EIA is classifying some of their exports. Some of their exports were really low, so maybe some of their demand was actually export demand. So that there are some of those differences. But really, the big picture here is that it looks like we've bottomed, and we're starting to see recovery in gasoline sales. And at its worst point in the middle of April, we were down almost 50%. Here's some of our key forecasts that we've been providing to our clients while this crisis is going on, something that we're always tracking on a monthly basis. And this was quite an exercise in February and March to try to forecast where gasoline demand was going to bottom out. It was probably one of the most difficult things that I was ever tasked with in my career thus far. Much worse than 2008 and 9 during the recession, and even during the golden years when things were great. And we really had to rethink how we were forecasting. Typically what we do is we have a VMT model, vehicle miles traveled, and we look at seasonality. But really what we had to do is look at our VMTs by type, because honestly nobody knew if gasoline demand was going to be down 10%, 20%, 60%. So what we did is we looked at from the BLS National Household Travel Survey. They have all the data as far as working commutes, work-related trips, shopping and errands, school, church, school and recreation, and other. And we had to work with our economics team to determine how each of these were going to be impacted. And what we saw is that about 22% of gasoline demand, according to that BLS study, is devoted to working commutes. Work-related trips is a very small percentage. Shopping and errands and social are two really big ones as well. And so when we did this exercise, we actually came up with about 50 to 55%, which actually ended up being pretty close to the actual reported numbers from Opus and also from the EIA. So I think the bigger question now is what's the recovery going to look like? And as you see, it is a V-shaped, and this is a big assumption, assuming that we don't have the disease, come back in force and additional social distancing happening in September, October, November as we get into the flu season again, right? So I will caution everyone on that giant risk here. So what happened when gasoline demand fell off a cliff? We really saw gasoline inventories really start to rise sharply, completely counter-seasonal, not the normal trend that we see as we go into the springtime. And that caused the gasoline crack spreads in New York Harbor, Chicago, and the U.S. Gulf Coast all to fall significantly, as you see in the chart at the bottom left. This is a topic that I feel that a lot of people are not paying attention to, that could really sneak up on the market, and it's really the Tier 3 standards. And what Tier 3 is it's a sulfur reduction mandate to reduce sulfur in gasoline from 20 ppm down to 10 ppm. And it's been well known and something that the refining industry has been preparing for, but not everybody is prepared. There's quite a few refiners that are still producing 40 and 30 and 20 ppm gasoline. And how do you get to 10 ppm is you have to spend money on hydrotreating and also do a couple of other things as far as yield shifting and adjusting your FCC units. But before the virus, this was something that we thought would really impact octane prices. We were expecting that, because as you increase hydrotreating utilization rates, you lose octane. And then there's similar regulations happening in India with Bharat 6, and then also China with Guo 6. So the entire world is trying to reduce their sulfur in gasoline. Europe already has their standards that are already at 10 ppm. And we expected this to lead to some increases in overall prices for gasoline and for refiners. What happened is initially the refiners were pretty worried about this because the credit prices didn't fall in line with the gasoline crack prices that I showed earlier. And what that would have meant is that they would have had to have paid a lot more on a total cost per barrel basis if the credit prices didn't crash. But luckily, over the past few weeks here and really in early April, we saw the credit prices fall back down to the $2,000 per million credit basis. But this is something that I think the retail industry and others should somewhat pay attention to, that they really haven't been here recently. Kind of moving on to U.S. diesel demand, I think the key point here is that it's also a very sharp decline, but it was slightly delayed. Part of this is because initially when the virus started, there was a mad rush for people to buy groceries, toilet paper, all the essentials that you'd need to be stuck at home for months at a time, right? And that did cause diesel demand to be propped up a little longer than gasoline, and it was kind of a head fake because a lot of the refiners saw that and they shifted their yields very quickly from gasoline and jet to diesel. But now we're at a point to where diesel demand itself has fallen. But the good news is that in the weekly data, it is showing signs of recovery again. But we again don't think that it's going to reach the pre-virus levels anytime soon. And this again is mainly due to the economy and trade specifically. A big piece of diesel demand in the U.S. is trade with China and other countries. And we've actually seen, for example, at the bottom here, we were down about 30% for diesel demand. And when you looked at Port of LA, Port of Long Beach imports from China and other countries, it was also down 30%, curiously. There's always been somewhat of a correlation between imports into the West Coast and U.S. diesel demand, because once those imports come in, you have to truck and rail all of those goods through to the rest of the country, right? And that's a significant piece of diesel demand, as you see in the bottom right. On highway demand is basically the king, whereas all the other pieces here are relatively small. But we did slightly underestimate, I guess, the bottom of this. We had demand coming in kind of down 22 to 25%, actually came in down 30, and that's really because the on-highway demand was even impacted more than we were expecting back in February and March. We were trying to forecast April and May. But we do think that inventory is close to a peak over the next couple of months. It's going to kind of plateau, and then we'll start to see it fall into the winter time. And as heating oil demand really takes off for the winter months, we'll see the cracks recover here, but not to the levels that they were at pre-virus anytime soon. So kind of tying in cracks for gasoline and diesel into what's happened with actual crude runs in the U.S. And some of you on this call are refiners. Others of you are dependent on refiners for your supply. And one thing you've probably noticed is that inventory is really high. You're probably not having to call your refining buddies or your retail networks as often because demand is impacted as much as I was showing, right? But really the impact of the weaker cracks was a significant portion of the market was seeing negative variable cost margins in the U.S. And that's why we've seen crude runs really fall off a cliff here. We've seen it going from, typically it should be around 16 to 16.5 million around this time of the year, and we're at around 13 million barrels of crude runs. And the bottom right chart is the real interesting one. That's the yield shifting that happened. So this kind of shows how initially refiners were hoping that they would be able to yield shift their way out of this. So meaning that they would reduce gasoline yield, reduce jet yield, and increase diesel yield to kind of balance inventory. And really the problem with that is that diesel also fell off a cliff a few weeks later. And this is completely counter-seasonal to normal. Typically, when we're entering the spring, we see gasoline increase and diesel decline. So we are now starting to see yield shift back to more normal conditions here shortly. But we do think that jet is going to stay impacted quite a while, but that's not really a big focus of what the membership of the Fuels Institute does. So moving on to some of our longer term views, I think one of the key points here is that we are seeing that U.S. gasoline demand by region had peaked and was starting to fall. We had a lot of questions on why there was an increase from 10 to 9, or really to 17 and 18. A lot of consultants and various others thought that we had peaked back in 2005 and 6, and we actually saw this kind of resurgence. A lot of that had to do with fuel efficiency standards. It takes a good 11 to 12 years for the fleet to turn over, right? So think of last year, think of 2019. That was one of the strongest economies that the U.S. had ever witnessed. We had really high VMTs, and we still saw gasoline demand decline slightly in 19 versus 18. And the reason this is that when you look at the fuel efficiency standards here, and really that the key point is that we're starting to see a sharper rise in fuel efficiency of the light duty vehicle fleet. It's really starting to pick up the pace because these efficiency mandates were put into effect about 12 years ago now at this point, right? So we're going to see that accelerate, and that's why we believe that gasoline demand in the U.S. will probably not get back up to the levels that we were at pre-virus. And why is that? A lot of it has to do with changes in that working commute category, but it also has to do with changes in restaurant visit behavior, visiting social events, sporting events. We think that there will be some pretty big structural changes that will happen that will impact gasoline demand here and see this kind of step change. And again, we go all the way out to 2050 for this forecast, but I think it focuses for the next 10 years. And the other interesting thing is that this chart on the right, top right, is a little deceiving now. And the reason it is 2020 was such a terrible year that it threw off the entire decade comparison now. So when you're looking at 11 to 20, it looks really bad compared to, the 2000s to the 2010s. But then when we look at 21 to 2030, it looks like everything's great again. And that's not really the case. We are going to see a recovery to 2021, but then slow declines through the forecast period. And you can see it in this bottom left chart where you see gasoline demand per capita really starting to follow a trend where it's been falling the past 20 years here. And we expect that to continue as light duty vehicle efficiency continues to grow. Another very important piece of the fuels picture in the U.S. is ethanol content in gasoline. We did kind of see a pause here in growth, and a big piece of that is that there's always been this uncertainty as to who is liable if a pre-compatible pre-2002 engine used E15 in its engine, right? Would it be the retailer that's responsible for the engine damage? Would it be the consumer? Would it be the auto manufacturer? And when you look at the fleet and how it turns over, we're finally getting to a point where there's not too many of those non-compliant vehicles that can't handle E15 on the market, which is why we do believe that there's going to be an increase in ethanol penetration over the next 10 years here. And most of that is going to be through cellulosic, through corn-based ethanol and not cellulosic. As you all know, cellulosic, there's been a mandate for quite a while, but just the capital costs and it's just been too high for anyone to have really a big penetration of the cellulosic ethanol market. Diesel demand, there's been these waves that are really dependent on what's happening in the economy. You see that, we had pretty strong growth from 2000 to 2007 or so, and then the recession happened. It took many years for us to see that drastic recovery, and what we believe now is we're entering another one of those waves. where we'll see a decline in diesel demand by region in the US. A lot of this has to do with the economy, but a lot of it also has to do with auto trends and the fact that a lot of the big delivery companies are switching to propane and natural gas vehicles. We're seeing the emergence of Amazon really come in and be one of the large shippers, and the impact of that is that they're using more fuel efficient vehicles than some of their competition. And so while GDP continues to grow and VMTs continue to grow for that's associated with the heavy duty fleet, it still impacts diesel demand in a negative way, similar to what we saw with gasoline. And you see that here when you're looking at the different contributions to diesel demand. You see the transportation-based demand is really the big piece here that's impacted, leading to lower diesel demand over the longer term in the U.S. So a little further out, once you go past 2030 and 2040 and 2050, we do not just trend line everything. We actually put a lot of science behind our 2030 to 2050 forecast. The process that we use, I mean, we actually developed a lot of this in the 1940s and 1950s. We've been doing this work for a long time as Pervin and Gertz and CMAI and other companies that I just bought over the years. And all of it has to do with really the economy and our views of the auto fleet and driving behavior, right? Those are things that we've been forecasting for a while. And over the longer term, while EVs are not a big piece of the pie over the next 10 years, they do become a bigger piece of it over the longer term. And also just continued improvements with internal combustion engine leads to a significant decline in U.S. gasoline and U.S. diesel demand. So what does this mean as far as how your suppliers go? What is it? How does the U.S. kind of stack up against the other regions? And you see that the U.S., even with the negative demand story that I just showed, is still able to really maintain its utilization rates. And the reason that is that they have access to low-cost crude, low-cost gas, and it's the most complex refining system in the world, right? So the proper investments have been made. The companies that are behind the refineries have pretty good balance sheets. And I would argue that there's even a chance that this is a little too bearish for the U.S. because we do have a resurgence in Latin American demand or runs as well. And so far we have not seen that with the situation in Venezuela and Mexico. Most of that is really a recovery in Brazil and a couple of other countries. So as far as your supply goes of your products, it should be relatively stable over the next several years. I think the one big red herring is that in the future, you're going to have to compete with those barrels in the United States with exporters, and as we increase exports to Latin America and to Africa. And this chart really demonstrates what I'm getting at here. Is you see that really since 2005 and 6, since Venezuela used to be one of the most complex and sophisticated refining systems in the Western Hemisphere, and definitely in Latin America. They also used to have the highest GDP per capita, but due to politics and a lot of other changes there, we've seen things change. And it was an opportunity for U.S. refiners to really increase exports into Latin America. And I'll show you our views on Latin America here in a bit, but there are opportunities as the demand declines in the U.S. to export more gasoline and diesel to some other regions, specifically to Latin America. So when you look at demand growth by region over the next 5 years, the U.S. really pops out here from 2020 to 2021. And this is what I'm trying to really emphasize, is that yes, 2020 was a terrible year, but 2021 could potentially be a great year because we're seeing a pretty strong recovery. I mean, definitely not up to where we were before, but this is significant growth year on year when you look at it that way. Same for diesel as well. Very strong growth in 2021. But I think the real big story here is that we're not reaching our 2019 levels for either product in 2021. And when you look at the world as a whole, you see here that we actually don't really get back to where we were pre-virus until around 2024 or 2025. That's with North America and Europe continuing to decline after they see their initial recovery. Most of this growth is in Asia, the Middle East, Latin America, and Africa, really the non-OECD regions. And the reason I put this chart in on the top right is really to demonstrate how important naphtha is for this part of the barrel, right? Because one thing that's actually a relatively big change in our long-term views that we're implementing this year is that in North America specifically, as gasoline demand falls, refiners will yield shift back into naphtha and export that naphtha to this growing Asian petchem market. And so refineries in Asia are, you might see in the news that there's a lot of new refineries being built there. And I caution people to think of them as only transportation fuels producers. They're petchem producers as well. There's a huge incentive there to build base chemical demand, ethane or propane and naphtha crackers, PDH units, supplying the chemicals market, and the ethylene and the propylene kind of required as their economies kind of continue to grow. I think the other thing here is you know, if I was showing you from 2030 to 2050, you actually would see a peak in the mid 2035s, and that's because of China really starting to level off its fleet, and China is very important, right? It's probably the most important market for the automotive fleet over the next 10 years, and it accounts for about 21% of at the peak of 2026. When you look at diesel consumption by region, again, pretty similar story. We don't quite recover over the next few years, but by 2023, 2024, we do kind of reach our pre-virus levels and see continued growth globally. But again, in the OECD countries and the developed countries like the United States and Europe and Eastern Asia like Japan and Korea, we are starting to see peaks forming over the next 5 years for diesel demand. Biofuels, it's important. It is something that's penetrated the U.S. market specifically. I showed you the chart showing that we are somewhere between 10 and 15% ethanol right now. But overall, when you look at the overall size of the liquid fuels market, it is a relatively small percentage of fuels, but it will become a greater and greater percentage as we move forward. And it's not just a North America story. North America is responsible for a big piece of it, but Latin America is also a big player in the biofuels market, and China is really trying to mimic and imitate a lot of what we've done in the U.S. as far as ethanol goes. So I mentioned Latin America is a very important market for the U.S. suppliers, and we see here why that is we have significant growth over the next 10 years. Most of that is kind of spread out through the region, but there is significant growth expected in Brazil and Argentina and Colombia. Mexico, they're trying to build refineries. We don't have that refinery in our latest balance. We do believe that there's going to be issues starting that asset up. And that's actually a change from our views of last year. And we really think that because of the economic impact of the virus on the balance sheet of the Mexican, of Pemex. So I think one of the key points here is that, again, there is demand that's backing up these exports that we're calling for from the U.S. China and India, very different story actually when you look at their trajectory. And this is, something that we've been watching really closely, and we actually are seeing a flattening of the curve of gasoline demand specifically in China over the next 10 years. And why is that? We see the penetration of electric vehicles there really outpacing what's happening in some of the other major regions. Like you see India here, for example, there's not really a big shift over to electric vehicles just because it's cost prohibitive and the population just can't afford the additional cost, right? So very different stories here for China and diesel. There's gonna be a lot of shifting of focus to India as being one of the major growth markets once we're into the next decade. Africa, a relatively small number, but it's important because they are not really, besides the Dangote refinery, they're not investing in additional capacity there. So they're going to continue to be more and more net short, and the US will have opportunities to export some additional gasoline and diesel to Africa as well. And you see the fleet there. It is growing. The vehicles per capita is growing, but we just don't see the penetration of electric vehicles or hybrids or anything else. And the Middle East, they're growing significantly, but they're also investing in quite a bit of capacity. So we're seeing an interesting story form there where they're going to become a bigger supplier to Europe and to Africa as well. So some of the key forecast risks is that we see death rates potentially seeing a resurgence that would really impact our forecast and cause us to have to redo things. The long-term forecast I just showed you, we really were in a bind having to redo all of our forecasts. We typically finalize these things in January and February for release in May. And we basically had to rerun all of our models to figure out how the virus would impact the longer term views that we have for gasoline and diesel. So we might have to do another round of that if we see the virus really come back strong in the fall. When you look at the degree of disease propagation, really it's hard to tell if we're going to see a similar impact in Latin America. And even if we do, and the reason I'm bringing Latin America up is that region and Africa are kind of the two delayed response regions that we're seeing where the virus could take off at a delayed rate compared to where it did in other regions. If that were to happen, that would kind of have another cycle of negative news globally, and we'd see how the economy would react to that. Trade pressure on refined products and what that means, and that's really a short-term thing, is during this crisis, I didn't really show any short-term trade slides. The one positive piece of news is that we continue to export gasoline and diesel from the US at pretty high rates. And unfortunately, it looks like this trade pressure on refined products is coming true now based on the last few weeks of data we're seeing. We think that inventory is probably full in most of the Caribbean locations and in Latin America as well. Europe is full. Vessels are full. So that's why we've seen exports really fall off a cliff here for both gasoline and diesel, and that's putting pressure on refiners again to whether or not they should start increasing crude utilization rates. Another thing is the viability of ongoing operations. There will be some refineries globally that shut down. That is something that you should probably pay attention to if you are, and really kind of be cognizant of your suppliers and what's happening there. And then obviously the return to work scenarios, there's so many different forecasts and ways to look at this that, it's inevitably we're going to be wrong with something with this, and we're inevitably going to have to change our views in the shorter term on some of that aspect of it. So that is what I had prepared for today. So I'm open for questions, Sean.
Daniel, thank you very much. So we got a couple questions, but I'm going to start off with kind of a general observation, and then one specific question. So what you just kind of went through kind of impresses upon the audience that, look, you cannot look at the oil markets in a vacuum. You have to look at the fuel markets from a global perspective because it's all interconnected. What happens in one corner of the globe is going to affect other corners of the globe. Would that be an accurate summation?
Yeah, it's very accurate, and especially when it comes to when you're trying to forecast pricing, you really have to know what's happening with the crude suppliers as well, right? Because crude is always the number one determinant of gasoline and diesel prices. Like if you do a regression and look at R squared, it's always the number one driver, and you can't understand the crude market without looking deeply into what's happening in Saudi Arabia and Russia and the Middle East. And also the US, back in the day when, I first entered the industry 20 years ago, the US was not a big exporter. We weren't dependent on the export markets to clear. And now we are, right? So, and what's actually happened the past few weeks is a very good, all of our clients now are asking us about, hey, what's inventory look like in Latin America? Why is nobody accepting any of our ships anymore, right? And so that's, these are things. And I used to lead our NGL group before this, and I actually used to talk to the NPGA, the propane alliance that's very similar to what the Fuels Institute is. And it was a really similar theme where the US, the retailers and the propane industry didn't really have to worry about what's happening in Asia, but because the US went from exporting 10% of its propane to 50% of its propane, they really had to pay more attention to what's happening. And that's why that naphtha discussion is so important, because eventually those gasoline barrels might be converted to naphtha or just stay as naphtha and be exported for petchem.
So a question of mine, and it kind of ties in a question we got from the audience. I'll start off with a question from the audience and kind of back it into mine. So when Saudi Arabia increased oil sales earlier this year, the question is, did they really increase production or just simply sell their inventory for a lower price? And then bridge into that, I think it was slide 11 or so of your presentation. You guys seem to be forecasting that oil is going to be in a deficit to supply. Supply will be at a deficit to demand by third quarter this year.
Yes. Yeah.
That is a quick recovery.
Yeah. And that's when you look at supply minus demand. So what that means is that we're going to be pulling from inventory at that point. And we actually are already starting to see that with gasoline, for example, in the US, right? We are now, it looks like we've seen inventory peak and we're starting to pull inventory to supply the market, meaning that demand is already outpacing supply, right? Mm-hmm. And it would be quick, but we're seeing record declines in US production, right? And we are seeing the Saudis and others really cut production as well, right? Whether or not they're going to actually follow through with what they promised and told the world is kind of yet to be seen. But that's also why we literally forecast and update the same chart every month here. And so that's a key piece of this, is that this is not something where you could just update it and forget it and assume it's going to come in right. It's something that we're constantly tweaking and updating monthly.
How flexible is the production capacity? If production's being kind of shut down, we're going to start pulling on inventories toward the end of the year. If demand continues to outstrip production and inventories start to get short, how easy is it for us to restart production to make up that shortfall?
So in the Middle East, it's relatively easy to bring back production, right? In the United States, it's a little bit, the process is going to take a little bit longer because there's been a laying down of rigs. There's been the oil field services companies have really cut staff significantly. So it would be kind of a tiered response where the lower price producers like the OPEC countries in the Middle East would come back a lot faster than the US. And just as a measure, we didn't really show our crude production charts, but we do forecast that the US production is going to fall from about 2 million barrels a day from 13 down to 11 to 10 all the way down to 9 by 2021 before it starts to recover here. And that is a key piece of this deficit number. If if we see that production is not falling as quickly as we expect it to fall, then this red will not be as drastic as we're showing here.
Another question here is a two-parter. So, comments, great presentation. And please provide thoughts on two factors that could be game changers for U.S. and potentially global fuel demand. One, hold on, it's moved on me. One is work from home will become much more common with companies possibly reducing office space. And number two is a trend in nationalism that may reduce trade and dramatically impact economic growth as countries reconfigure their supply chains. General thoughts on those?
So each of those would be not a good outcome for the fuels industry, or actually people that are trying to sell fuels, right? So working from home, according to the kind of the BLS data, is again, total commute to work is about 22% of VMTs, vehicle miles traveled. And if that's significantly impacted, you could see, let's just say that's cutting 50%, that's a 10% decline right there in gasoline demand. The other thing is just really the social events aspect of it. Watching Lakewood Church from home instead of visiting church in person, things like that would really hurt gasoline demand. Diesel, that's a really good question on nationalism. The entire diesel story is really based off of transportation demand. And while it's tied very closely to GDP growth, if you suddenly see a huge cut in goods movements between China and the US and goods movements into the West Coast, you see that in the diesel demand numbers as well, right? So both of those would be bad from a product perspective. If the argument can be made that it would cause GDP to be a lot higher, let's just say that the nationalism led to a resurgence of manufacturing in the US and all of that, then yes, that might kind of negate some of that, but it's kind of a tough question to answer, right? Based on what does that nationalism lead to? Does it lead to more manufacturing in the US? Then if it does, then maybe that negates the loss of the trade, right?
And then another question I'll bridge as well, combination of teleworking, yet we saw a presentation from Deloitte this morning that shows people are leaning towards more personally owned vehicles, away from mass transit. So you start teleworking, but then you also have people who used to take the train saying, I'm not going to get that close to people. I never like being around them that close anyways. Now I want to be even further away from my health. How might those offset one another?
So it's going to depend on if you're talking really specifically about the US, it's going to depend on each metro area, right? So in Houston, for example, most of us don't use public transportation, right? We take our car, so it's not going to be as big of an impact here. But there are some people that take park and rides, so it could be seen as a positive impact for Houston. But New York and other regions that are heavily dependent on public transportation, I mean, they're not going to be, a lot of them don't have the choice, like they don't own vehicles, right? So if this actually leads them to buying more vehicles and or using Uber, then obviously that would be good for gasoline demand, right? It's just in our auto forecast thus far, we've not tweaked things for that until we actually see some data that's starting to happen. And I think the Deloitte survey is going to be very important for that, to see if we're seeing a shift in the actual consumer behavior in some of the public transportation markets, right? In Europe, we are actually seeing a lot of that. A lot of our colleagues in Europe are actually living at their summer homes. That's actually a pretty common thing in France, to where most people there have country homes, and most of them moved out to their country homes during the crisis, right? They're driving versus taking public transportation.
Right. That Deloitte comment that people are looking at their personal vehicles, KPMG released a survey results about a week or two ago as well that said the exact same thing. So, but you're right. The question is, consumers say this, but what are they actually going to do?
Yeah.
We have a few other questions here, kind of related to the coronavirus, and wondering if your forecast for demand recovery, what's your flex scenario in case there's a resurgence, we don't have a vaccine yet, in case there is a resurrection of stay-at-home orders? How does that demand profile flex in the next 12 months?
Yeah, so we actually, in our forecasting, we typically do 3 different scenarios when we present our base cases, but we actually do have a W-shaped scenario, and it looks more like a roller coaster where we see a decline. And we have an epidemiologist on staff, and one thing that he has said is that if the disease comes back with a vengeance, it'll be during flu season, right? It'll be in October, November, December, and it won't be delayed to March and April like it was this year, right? So if that were to happen, we still think that there's going to be a large percentage of the population that will just, at that point, ignore the directives and just continue to live their lives. So we don't think that demand will fall 50% again if we had a resurgence of the disease, but it could fall back down to 30% or 40%, right? But we don't think it'll fall all the way back down or be worse than it was at the bottom that we had here in April in the US specifically.
Okay. I got one more question for you. It's my own question. And it relates to what we saw happen with diesel demand. And you mentioned IMO 2020 in passing. And I'm wondering if the sustained demand for diesel at the beginning of the pandemic was related to marine demand for diesel. And then once we started realizing that overall economies across the world were shutting down, that slowed down. So what impact is the marine demand having on diesel demand during the pandemic and going forward? And has IMO 2020 gone, clearly there's a lot of noise in the data right now, but do you see IMO 2020 being kind of, we're implementing it without a problem, or is there still a risk of the draconian forecast that were being put out there by some stakeholders?
So I think there's like 3 different pieces here that are moving. And the first piece of IMO was, before the virus, was whether or not there'd be enough VLSFO available. So very low sulfur fuel oil available. And I think one thing that surprised the market is that there was a strong amount of VLSFO available for the shippers, and that led to the diesel cracks not really taking off as much, right? And then the second piece here, post-virus, is overall marine fuel demand down? The answer to that is yes, it's significantly down. And so you're now not as short diesel because of that, right? Like you can basically shift over some of your diesel that's building up in tanks and inventory because of the economy being weak into the marine fuels market, right? But I think without the IMO regulations, diesel cracks would be even worse than they are today. Because there was some implementation, and a lot of the bigger lines did shift away from high sulfur fuel oil and to ULSD, and to lower sulfur gas oil. And so I think, long story short, the IMO impact was muted significantly due to the virus, but it still did have an upward impact on demand. It's just much, much lower than it would have been pre-virus.
I lied. I have one more question, and then we'll let you go. With your forecast recovery, in the event we had the first named storm coming to North Carolina right now, in the event we have an active hurricane season, or in the event people come out of their homes and the politicians have gone a little loopier than usual and military conflict starts to break out in different areas, does that benefit recovery because it's taking supply off the market, or does it just complicate everything and throw it into a tailspin?
From a supply standpoint, right now, we have way too much gasoline, diesel, and jet inventory. So it would help in a way if, but the issue is that a lot of the Gulf Coast refiners are already down right now. Like they've reduced rates, right? So if they're forced to reduce rates more, the only benefit here would be that we'd see inventory come down a little bit faster, right? For gasoline, diesel, and jet, right? But so net, it would kind of help the imbalance between supply and demand in the U.S. right now with products.
Well, thank you, Debnil. I really appreciate you spending the time and sharing your guys' perspective with us. That wraps up day one of Fuels 2020. Everybody, thanks for sticking by us all day. Tomorrow we start at 11 o'clock Eastern time with Dr. Schlafly from the University of Maryland. He's going to be talking about a variety of social behaviors in terms of what do we expect people to do? What are consumers looking for? How can businesses respond in a post-coronavirus market? And how do you take the lessons we've learned and apply it to a more flexible business strategy? How does delivery at home, last mile delivery circumstances affect your business strategies going forward? And how do you develop those strategies and make sure that you can flex to service your customers as best as possible? And then we're going to close with Scott Shepard from Guidehouse, formerly Navigant Research. We're going to be looking at the automotive industry, looking at what were the trends leading into 2020. How has the COVID situation affected production strategies? What might we expect coming out of 2020 into 2021 in terms of vehicle production plans and powertrain diversity? Don't miss it. It's going to be two great sessions, 11 o'clock tomorrow morning, followed by 1 o'clock tomorrow afternoon Eastern time. Same bat channel, same bat place. Thanks a lot, everybody. See you tomorrow. Bye.